G'day, listeners, and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and today, guys, I am pumped up because we have got a very good topic combined with some very, very good co-hosts here today. I'd like to welcome back to the studio the big man. I have not seen him in quite some time. Big Mr. Lukey Chusa, mate. Welcome back to the show. The fan favourite, buddy. How are you?
Fan favourite. I wouldn't go that far, but great to be back.
You're more popular than Jimmy, so you're second from the bottom.
Yeah, absolutely. I'll take it. I'll take it. But back in black today.
Oh,
back in black. So
have you dyed your hair as well? Your hair's looking more black than usual.
More black, but a little bit of salt and pepper. Actually, Tali's been telling me she's seen it more in the reflection, but we'll see. I think it's because I don't know if it's the stress of working with Sammy or maybe the stress from Jimmy. I don't know.
I think as soon as you start working with Sammy, I had full brown hair. Started working with Sammy. Now
it glimmers in the sun.
Glimmers. Sparkles, in fact.
Sparkles. I love it.
So,
Yes, I think it's contagious to catch the shit hair from Jimmy, and Lukey, it seems you have done so.
Lukey, speaking of grey hairs, don't you worry. The bull shark over there is getting a few. I've noticed a few little creeping up there.
Mate, they've been there for bloody ages. I've been investing for too long to not have my fair share of grey hairs. But speaking of grey hairs and speaking of dogs, Jimmy, mate, welcome back to the show. It's great to have you back.
How is the dog and the grey hair?
I just looked at you, thought a dog and said it, so...
Good to be back. Question just off the top. Which bank are we robbing today? Because we've all got black hoodies on.
We are robbing the Bank of Australian Property. Guys, we have got, check this out, we've got the new Australian Property Scout hoodies. We are repping all three boys in here wearing the Australian Property Scout hoodies. They're looking fresh, boys. Literally delivery just before we started. We thought, why not? We don't need it in Queensland. You don't really need one here. It's that good. But mate, they're looking fresh, boys.
Comfy.
Lukey, yours looks a little bit better than Jimmy's, but Jimmy, you're still passable, mate.
Mate, these are so comfy. I'm telling you, I love these. What do you think, Lukey?
I think they're good. I think it's actually getting colder here, so it's not like down in Melbourne where you are, but it's getting colder, so I'll definitely be using it.
You're glad you've got one?
Absolutely.
Beautiful. The Australian Property Scout hoodies, they are on and we are ready to fire. Now today, guys, we are obviously one of the biggest reasons you probably clicked on this title is one of the big things that we see so many people get stuck with. And all three of us really on the front end, Jimmy especially on the disco calls, and then Lukey and I are doing a lot of strategies with clients as well. And the topic of today is why so many investors get stuck at one or two properties. And if you look at the averages of the percentage of investors in Australia that do get stuck at only one or two properties, the numbers are ridiculous. It's something like, I'm pretty sure it's in the 90%. I think it is if you take all the way up to only two properties. So either zero property, they've got the one investment property or the second investment property. The vast majority of people never get beyond that. So what we're wanting to do is create a bit of clarity around this and have a bit of a conversation as a team as to the most common mistakes we see people that force people to get stuck at that, and then what stops people moving forward and getting beyond it as well. So bit of an open floor, guys. We have an open mic, as it were, to discuss today the real key points and topics around this so people can then implement it in their own portfolios and make sure they don't get stuck.
I love that.
What are the key thoughts, boys?
There's so many things to unpack here. And, you know, it's interesting you just said those stats. I actually have those stats in front of us if you're just curious.
Hit me, Jimmy.
71.48% of investors hold one investment property.
78, okay.
18.86% of investors hold two investment
So
properties.
we're talking... Hang on, is that right? So that's
Less than 20% own more than two.
Yeah, so he's talking... That's nice. You said
So it's
78% plus the 18. That's what's that, 96%?
You're right.
Bloody hell.
And if we
That's
fast
massive.
forwarded all the way to at least 6 or more investment properties, 0.89%. So the stats are clearly there. There's a reason why most people don't accumulate more properties.
Can I ask you something? You bought your first property, Jimmy, in 2000...
2003.
I thought it was 1903.
Good deal. Good deal. No
2003.
tax.
2003,
It was with
right?
cash.
Gish. It was 32 cents and one peanut.
Yeah.
All right, so...
Two chickens and one cow is how he paid.
and his daughter.
He went low. He did. He
Go
had
low,
to go
didn't
low.
I saw the settlement statement written with crayon. Anyway, so back in 2003, you bought your first
Correct.
one. Let's
First
be
deal.
serious about this. First deal in 2003. When did you buy your second deal?
2016.
Okay, so 13
Or 15,
year.
15.
Okay, so 10 plus year gap. So I think a really interesting case in point here. 10 plus years, right, between
Yeah.
your first property and your. Before we even dive into the notes that you boys have got and what you're wanting to unpack,
Yeah.
why did you only buy one property?
Well, first of all, I was working overseas, so I sort of put my head in the sand. It was like almost in the too hard basket.
When
type
did
thing.
you go overseas?
Oh, well, basically 2001. So I sort of bought 2003 while I was
While you were
back
away.
and forth.
Okay.
Away. And then that house is the one that burned down, remember?
Oh, I remember.
Yeah, and then there was just a block of land. But the reason, if I was to really dive deeper, I didn't know what I was doing.
Okay.
And so the first one took action, did that. But then moving forward, I just didn't really know where to buy. And I think by that point, I sort of missed the pricing in Melbourne and didn't know where to buy. And
Did you still want to buy?
of course,
So you still wanted to buy. So it's a lack of
100%.
education and lack of
100%.
ability of being able to move forward.
the education piece of not knowing what to do is the number one thing that will stop people. I mean, fear is definitely there, but I think you overcome fear by being educated. So yes, the education of not knowing what to do is I find the biggest thing that will stop someone going beyond one or two properties.
Very interesting.
That's what I think personally. And that, because what that leads to is the strategy, right? So if you're educated, you understand the what. And often on the discovery calls when I'm talking to clients, I often say, if you're at a barbecue with your mates or with your family and anyone's talking about property, what does everyone say? Yeah, oh mate, you got to get that, down the coast. It's going to be an absolute cracker. Everyone's talking about the where.
Yeah.
No one at that barbecue is saying, Sammy, what do you think you need in your property portfolio?
Unless Lukey's at that barbecue, which we know he loves to frequent. He might be
does.
at the barbecue.
He loves
If
it.
Lukey was taken out of the picture, no longer at that barbecue, I agree.
He'll be cooking the snags, actually. He'll be on the
he's
barbie.
too busy. He's
Yeah,
too busy.
Too busy.
He burned his tongue eating a red hot snag straight off the coals.
It's the reason I was cooking the snags is because Sammy ate the steaks before they were cooked. He's on carnivore.
That's
He just
true.
eats it raw.
That is true.
He loves it.
But no one
Cracked
is
an egg, bit
talking
of steak
about
up there.
no one is talking about the what. No one is talking about what do you need in your
Yes.
portfolio, which should be the first thing you focus on. And if you get the what right, then the flow and effect of 1, 2, and beyond becomes a lot clearer.
I'm gonna have a little shout out here to Mr. Yao Chen, our friend. Absolute legend, mentor and client of mine in School of Property. And it's so funny you kind of say that because the first deal he did with another buyer's agent, the guy just had, I have an $865,000 pre-approved, like maximum purchase price. The guy just went out and bought something at that. They're low income earners. They didn't have the ability to carry something overly negative. And this thing was like 30 grand a year. It was, he was going to go under hanging on to it. Zero strategy involved with this thing. Just, here's max pre-approval. Here we go. Go find your property, fill the max pre-approval. And then poor Yao Chen was going under, and then he had to go through the stages of having to sell that down and then build the strategy moving forward, and knowing and understanding what he was putting in the portfolio next allowed him to, really sort of change that. And now he's I think 3, 4, he's going for his 4th property now as well. So, understanding that strategy piece and not just being like, okay, well, I've got a pre-approval, let's go max it out. And that's probably one of the biggest things where most people get stuck is they don't understand. They just think, I get a pre-approval. I've got 750, a million, 500 grand, whatever it is. And they just go max themselves to that top point, and then they get themselves stuck because they don't have that serviceability left in the tank. And they haven't created that strategy in terms of how do I keep moving forward, not just buy one property.
And in terms of the finance piece, I mean, most people think a more expensive property is going to be a better property. So that myth in itself is a massive obstacle because they do get into that serviceability wall thinking, well, it's more expensive. It must be a better property. Yes, it might be a better property, but is it a better investment? That's the big distinguishable thing.
I think a part of that as well is because they're used to where they live. If you're living in a nice own-occupy area and all your family live there as well, and all the houses there are $1 million, 1.5, 2 million plus, or even like 700-800 grand, their view on property is, well, all the properties around me are this price, so why wouldn't I buy at that price point? They don't have that understanding or education that there's markets or areas outside of where they live or where they know that, the pressure and the sort of economics of it is other price points work better. You don't have to necessarily buy in the price point that or, surrounds you and your family.
Yeah.
So
I agree. That's probably one of the huge things. And it goes back to not really understanding what they're trying to do. And this is something we see a lot of people starting out make this mistake, right? And that's probably why most people get stuck at one property, or the two could be their primary residence. And then that they live in a local area where maybe they can buy the 700,000-800,000 similar to what they live in. And they just get that pre-approval and they go and buy it, right? And a lot of the time we see this as a novice mistake. And what we want to obviously empower people from this episode today, and what I would urge people to do out there, if you know, or you got mates or something, or maybe your sister or your son or whatever is about to buy their first property and they don't have understanding around, or maybe your parents, they don't have understanding around this, mates, whatever it is, I'd encourage you to send this episode on to them, especially if they're starting out, because really, like, you don't want to be listening to this episode when you are stuck at one or two properties. You want to preempt it, and that's the whole point of a strategy. It's preempting getting stuck and being able to keep building the portfolio going forward. So this is where I think is I think this will be a really key and a really important episode for a lot of people out there starting out, to then how they're going to keep building the portfolio moving forward and not make the mistakes that so many people do that end up with them getting stuck.
That's such a good point, Sammy.
Thank you, Jimmy.
One of the calls I just had the other week with a lady, Jess, she's a jockey from New South Wales.
Oh, how good.
Pro jockey. And she started listening to the podcast.
Jimmy's got a similar, you guys have similar builds, yeah?
Similar builds.
She's extremely talented and fit and very attractive.
And very small. I'm guessing she's also very small.
So
shout out to Jess, by the way.
Shout out to Jess. Recently signed
By
up.
the way, Jess, this is not digging. The whole point of that was to call Jimmy small.
We know. And Jess was referred to the podcast after she had already bought her primary place of residence.
Yes.
And I remember her saying to her cousin, you should have told me about this podcast before I bought the primary place of residence.
The biggest thing we always hear is people saying, I wish I found you guys before I did this or that or whatever. And it's crazy, man. Like, again, it's all about preempting. When you preempt it and then you have the right strategy to move forward, that's how you win. And you can still obviously win, but if you get in a point where you're a bit stuck or you're a bit far along or whatever, it's harder to then, you have to sometimes take some steps back before you can keep moving forward properly. Like Mr. Yao Chen.
It's funny, like, even I had a client describe his own occupier as a bit of an anchor. And, he had the PPR. We went out and bought him a few really good properties, and he saw the success and the growth and the performance of the properties. And he goes, I'm selling this anchor. He's selling he's actually sold it now. And basically that debt back and the capital back, he, can pretty much just continue moving forward long term. So,
nice.
It not necessarily means you can't do anything with one. It just means that there'll become a point in time where it's either going to continue to be an anchor or hold you back, or you do something about it as well. So
we're recording this sesh the morning after we did the live Q&A webinar for School of Property last night, right? And Australian Property Scout memberships as well. And we did one of the questions was around that. I don't know if you remember, Jimmy. It was around how much does it actually change? And we ran through the scenario of what you could do if you were to sell down. And I ran through that over, 5-10 minutes or whatever it was, breaking down the scenario of if they were to sell the primary residence and rent versus compared to holding that thing, and then how do you work out the opportunity cost and all that sort of stuff. So it's that was a really prudent sort of question and run through with that as well, man, of people understanding the difference, right, and the results, how they can change from that perspective.
And when we're talking about strategy, I mean, if people have bought their primary place of residence already and they're thinking, no, I'm going to do this, time in any market's going to probably make you look good if we're looking 15, 20, 30 years. But when we're talking about investing, we're talking about the opportunity cost of time. Time is the number one asset that you have to compound your wealth, right? So if we get the decisions done well, it's not saying your strategy won't work, but what is the best way to do it? And that's why we don't want to get caught out by buying the wrong type of asset with the wrong strategy. And I know we touched on primary place. We're talking about investments and people potentially buying the wrong investment. But one of the big things that I find where the biggest mistakes from the calls that I hear people saying is, I've bought my primary place of residence because I wanted to get the first home buyer grant, and then I'll turn that into an investment property, and then I'll start building out my portfolio. That is, you probably hear that as well, Lukey, in some of your calls.
The other thing you hear is like, why would I buy an investment property first? Because I'll lose my stamp duty exemptions or my benefits for my first homeowners grant. So, yeah, you hear what you said a lot, but you also hear the flip version is like, well, investment property first doesn't make sense because I'll lose all these benefits, but they don't really see the bigger picture in terms of what an investment property will actually do for them. The performance on that is... obviously generally a lot better.
Let's dive in that for half a second, because like I did the news bulletin a few weeks ago or a month ago, whenever it was, about South Australia abolishing stamp duty, right, for first home buyers. And I think what the really key thing here that a lot of people don't realise is almost all grants these days are geared towards new homes. Yeah. So they're trying to take first home buyers out of the existing housing market and put them into the new build, so that land's being developed or units are being built or townhouse developments or whatever, and they're being sold off by first home buyers being given grants and incentives around that. And the example was at the moment in South Australia, if you buy something brand new, being constructed off the plan, all that sort of stuff, you get the stamp duty exemption plus the first homeowners grant. They pulled all these caps off, and like realistically, it sounds great in principle, right? And like the scenario was literally if you were to buy, and by the way, guys, this is only for SA, right? But if you were to buy a property up to 750,000 and it was brand new or being developed, you'd get stamp duty exemption, which on that property was $35,000, and then you get a $15,000 first homeowner grant. The thing that you've got to realize with that product is that a builder or a developer has got his developer's margin on it. Or if you're buying through a house and land package sort of consultant, they've got their comm structures built into it as well. So you might feel like you're getting a win by the 50 grand, which is a huge sum of money. You might feel like you're getting your win from that side of things, but how much fat has been built into this deal? Because you're getting the end product. The developer gets his margin, the builder gets his margin, the sales guys get their margins. Like there's just so many pieces of the pie being taken out before it gets to you, and that's where it's just like it never really makes sense. And also, if you were to buy something off the plan of being constructed, it's 12, 18, 24 months away. Okay, cool, like you get those grants, but now you're out of the market for 12 to 24 months, which what else could we have done in that time frame? So I always look at the opportunity cost of this thing and being out of the market for that sort of time frame if you have to do new product, which almost every state in Australia these days, the first homeowner grants and stamp duty exemptions relate to new homes or new home construction. So it's so hard. I mean, Luke, you came from that industry, man, and have seen the way it sort of plays in the back end as well. And how hard is it to actually make margins on this stuff and win other than your supposed saving?
I think your point you made just there, you brush over a little bit, is it's an end of the line product.
Yes.
An end of the line product is everyone's taken their clip along the way. You've got the developer.
That was the pie analogy, bro.
I love the pie.
You love your pies, don't you?
Absolutely. Yatla pie way home. Absolutely.
Is that a 4 and 20?
Well, no, where's Yatla's bloody advertising? We need to hit him up. We're the producer. You need to hit up Yatla Pies. We want a endorsement.
Is this show
Absolutely.
popular enough to get a sponsorship of pies?
I reckon it is.
Absolutely.
Bro, at least half of our audience would have to be tradies. Man, I spend my time on the trade site, bro. I would eat at least 2 pies a day.
Mate,
minimum.
You were eating pies outside of the tradie site. You would just eat them normally.
100%, still do. But still, it gets bred into you as a tradie or as that background, labourer, tradie, farmer, whatever. Mate, you love a good pie.
Yeah,
you love a good pie. Maybe we'll get a billboard at Yatla Pies.
We'll discuss it.
And we'll get them to sponsor it as well.
End of the line product. So one of the things I wanted to touch on was numbers wise. Like a lot of people don't realize the commissions that go into actually what people get paid to sell these sort of style of properties. At the moment, it's sitting somewhere between 25,000 and 50,000 per off the plan build.
Yes.
So let's say, for example, use the example of South Australia. You get 50 grand across your stamp duty exemption and your first homeowners grant. You've got when you buy a new house, you're paying the person that sold it to you at least somewhere between 30 to 50 grand in a commission. You've also got the developer's profit put in there as well. The other thing that a lot of people don't look at is the holding cost. So property is taking somewhere between 12, 18 months, 2 years. I've heard of some blown out to 4 years. There was a lady I looked after. I spoke to her this month. She had 4 years to build a house in WA, which was crazy.
It took 4 years to be built.
4 years. They started in 2020 and it's finishing end of this year.
Wow.
So
when did you settle on the land?
It started 2020.
Jesus.
Yeah. So what a lot of people don't realize is if you're renting and you go and buy your first home and you've got all these grants, so 50 grand, awesome. You're paying the person that sold it to you 30 to 50, you're paying the developer, but you're also covering your holding costs.
Yeah.
So let's say, for example, you're renting at $600 a week, $500 a week, whatever it is. You're looking at 30 grand a year in rent.
Take the rent out of the equation, because let's say if you were rent vesting instead and just the holding cost of the actual property, because if you were rent vesting instead and invested somewhere else, that's perfect, right? Like renting somewhere, investing somewhere else. Give us like the holding cost breakdown purely of obviously waiting for that asset to be finished.
Yeah, okay. So basically you settle on the land and then you're your repayments straight away. You're not actually living in the property or getting any return from it. You then also got interest only repayments on the construction portion. So let's say your construction portions, you buy land for 300, 400, 500 grand depending on where it is, then you're building on top of that. You're paying repayments on the land straight away, and then you've got interest only repayments on the build for the entire period. So generally most construction loans are progress draws, so you pay incrementally more every
Each
time,
stage.
every stage that gets completed. So if you actually worked out the whole, obviously it depends on the purchase price and how much the builders, all that. If you actually work out the holding costs of the property while it's being built from when you settle on the land to when it actually gets handed over to you and you could live in it, minus your agent commissions, your developer profits, your builder profits, you are behind. The first homeowners grant and the stamp duty exemptions just do not cover the cost.
Look, the times when they work, in my opinion, and I agree with you completely here, man. You're just obviously diving a bit deeper into it there. I think Lukey's missed out on his pie this morning. He's not quite as sharp as normal. But look, I think the times that it does work, that a first homeowner grant can work, is when a market has flatlined or we're in those real stagnant periods and they bring them back for established property. The only caveat on this, though, is it does always put a little bit of extra fire in the market as well. It always does. But like if the market's stagnant and you're in an area where you think all the data stacks up that it's actually going to go through a growth cycle, and then you can buy in there at a discount plus get your grants and stuff, live in it, potentially have your capital gains tax exemption for a primary residence and go through that, then it's like it's a half conversation worth having. But 99% of locations in Australia don't offer that, or the grants don't even cover that at the moment, the grants and the exemptions and whatnot anyway. But then, being able to find that right product and enter at the right price and everything, and the chances that where you would want to buy to actually live in for the first home is going to match that, it's just such a tiny percentage. So I think what we do is just like, we gave the examples around it why we don't believe it's a good option. If you want to build your portfolio and you don't want to get stuck at one or two properties, that's probably one of the biggest things that we would say. Don't be looking for that owner-occupier first. Can you rent first and go build the portfolio somewhere else so you're not costing yourself downtime in the market? You don't have these blowout holding costs, and you're undoubtedly probably buying something that's market value or above just to save yourself some money from entry costs on that side as well. So we'll move past that side of things, but I agree with you completely, man. I think people have got to be very wary of it from that perspective. Moving forward, I think the other big thing, Jimmy.
I was just going to say, even towards the end, though, when it is complete, like that example in Perth's had a massive run, right? But for most people, by the end, the value of the house hasn't done anything. But they've signed a contract 2 years ago. So if you think about that, if you've paid $750, but by the time it's built, the value is still $750, would you have ever invested in an established market for the same price for it to be the same in 2 years?
But even look at that. Even look at that chick, right? Let's say she timed Perth pretty well, getting in early 2020. It was obviously a primary residence. So it was a primary residence, or it was an investment?
It was investment.
Investment. Okay, right. So the timing wise was good. Let's say she doubled it. But if she wasn't able to do anything else in the market in that same time frame, sick. Okay, she might have doubled the value, but she hasn't. If it's an investment, she hasn't even got any grants or benefits out of it. She could have gone and aggressively build out the portfolio in Perth, like we helped heaps of clients do in 2021, 2, all the rest of it, and seen significant growth that would have outpaced that anyway. So I think this is one of the biggest things. The time out of the market is the killer, and that's the opportunity cost that you've really got to understand from that perspective.
All right. You've also tied up your servicing for that period of time too. So if you buy that $750 example, you can't go and buy anything else generally while banks are doing construction finance. So.
Which is a great segue to, we've gone really deep about strategy, but let's go into the finance side of things. And I know one of your points, Lukey, was around maxing out your serviceability with your first deal and why that stops you. So you just want to run through that?
It's pretty common to see people go and buy where they live or where their parents have lived or, where they think is a nice area. They go and buy a blue chip property with the maximum that they can afford. That's the easiest way to get yourself stuck at one property. Absolutely.
And what about also the structure of the loan, Sammy? A lot of people don't understand the difference between, should I be principal and interest? Should I be interest only? Should I be 80%? Should I be higher?
Realistically, it all comes down to an individual and their circumstances on that front, because interest only actually doesn't increase your serviceability. Principal and interest actually is slightly better servicing because of the time frame, but the time frame to repay the debt, right? So if you did a 25-year, a 30-year on both, but you had a 5-year interest only period, the idea around this is you have 30 years to pay off the P&I on the one that's P&I from the start, and only 25 years to pay off the P&I that's on the 5-year interest only to begin with. Now, why that's important is because that actually impacts the borrowing capacity a little bit on that front. But realistically, almost everyone, especially in the current market we're in right now, almost everyone needs to do the interest only from a cash flow perspective. And that's why strategy is so important to understand it. All right, if you're a baller and you've got, a really big income, you can facilitate, and cover that, and you're not worried about it, that's one conversation. But realistically, serviceability is not your issue on that front anyway, or shouldn't be. So I think this is where just really understanding it from that front and then building it into the strategy. But what I would be more focusing on is what are the properties that I can put into the portfolio at interest only, so my cash flows are easier to manage during this process. That's going to allow me to continue building the portfolio as well, rather than kind of worrying about it from a serviceability perspective. It would more be from a cash flow management side, which again can stall you, because you buy one or two that are very negative and are at the wrong numbers. And if you do them at P&I as well, you could be bleeding a significant amount of money per property.
I think that point is a good transition to one of my points as well. With your negatively geared properties, having a negative hold on a property is pretty common at current interest rate environment.
100%.
Something we expect.
Yeah.
But, you also hear people holding 30, 40, 50, 60 grand negative on some blue chip properties. So you go have one or two of them. If you go compound that across both properties, you've got to have a very significant income to cover that, because not only is it a holding cost, it's a net holding cost.
Yeah.
So you've got to earn far more than that to actually get that amount. So
Man, it's a great point, because I've seen some people before come out on social media and they go, "Oh, if your property's heavily negative, just pull out some equity and then use that and I'm like, right, so you're going to pull equity to hang on to something that is significantly negative. That just doesn't make sense. Like, let's say you had built yourself a 10 property portfolio and at current interest rates it was running 20 grand a year negative. Okay, if you pull out 100 grand worth of equity, you're covered for the next 5 years and you can sleep well at night from that perspective, because you've got the buffer built in, but you've built the huge asset base that allows you to cover it. But like Lukey's saying, if you've got two properties there that are costing you, let's say 40, 50, 60 grand each, you've got two properties instead of the 10 that are costing you 100 grand a year or something. That just doesn't make sense, But when you build the portfolio out correctly from that side and know how to manage them from that side, it's not a bad strategy. I did it a little bit as I went, but it was to cover. I used to look at it from an annual perspective. I'd pull it out early because I'd know my portfolio was at a certain point. I'd let it cover it for that year, and then the next year I'd look at it. But it was minimal, and it was getting me through. But also the portfolio was significant. So the growth I was having, like I'm talking maybe 10 grand a year negative. This is pre selling down Wollongong and starting that whole transition, but I was getting $400,000 or $500,000 a year in growth for 10 grand a year negative, from the portfolio. So, but understanding that and then understanding what levers you need to pull to keep yourself moving forward, all this stuff keeps coming back into my head. Almost everything we're talking about. I think this is why it's really important to have a mentor or a strategist that you're working with in your portfolio. So we're throwing all these ideas out there, but the idea of it is if you're working with a mentor or a strategist or someone who understands how to actually build this out for you, they can help you create that game plan and that strategy that's tailored specifically to you. And that's what's really, really important, because, you could hear all these different things and going, oh, it feels like maybe the boys, they just, there's all these different things that could be done or could get stopped and all the rest of it. But it's like, so often it's actually so much more simple than you think to keep moving past two properties. Like you look at Yao Chen, he was dead at one deal, like he was gone. And now he's gearing up and he's going into third and fourth deals, you know what I mean? Literally in a 12-month turnaround window. Him looking or hearing this 12 months ago, he might have been like, I don't even know what to do. But then he's had the right mentor. We've built it the correct way, put the right properties in the portfolio, and now he's building a significant legacy piece for his family.
What's been really awesome with clients that I've been speaking to is their understanding from listening to this podcast about certain things that they're getting advice from their broker that raises an alarm bell to them, and they've realized early in the piece that this person isn't the suitable person to help me build out my portfolio. And it actually gives me a bit of a goosebump feeling when I'm on the call, because I'm just like, that's such a massive breakthrough that they wouldn't have realized and got themselves caught, like cross-securitizing or doing things that weren't going to help them in the long run. And so my question to you guys is, how important would you say that team around you to get beyond one or two is?
I'd say it's everything.
I was about to go, let's go 3, 2, 1. It's everything.
Yeah.
Oh, you're going to say the same thing?
Yeah, 100%.
But I think it's massive. And what you just said there is really cool, because I had that very same feeling. I had a client and they said, my broker was telling me to cross securitize, but I listened to the poddy and I was like, no way, I'm not doing that.
No way, Jose.
It's so good, isn't it? It's so good.
He did the little leg finger. I was waiting for it. I was waiting for it.
Yeah, we should have done a double finger.
Oh man, that'd have been good.
But like that's a really cool moment because like they're learning those sort of things, and we were talking about this earlier with the beginner, intermediate, and advanced investor mistakes. You know, people that are at a beginning phase, they're looking ahead and going, well, these are problems I might be seeing in the future. How do I avoid them before they hit me in the face? You know, like, and that's sort of a really cool point to sort of make as well. But I think it's everything, realistically. You know, the data doesn't lie. You've got very small percentage of people that get past two on their own, realistically.
Your team will make or break you, right? So, like, you could source the best deals in the world, or you could have the best deals in the world sourced for you. But if you have the wrong broker or the wrong accountant or the wrong, literally, property manager, anything, any of these sort of things, right, they can bring the journey unstuck. The team is literally everything. It is so important because, I mean, I've said this a few times as well. There's no... I've made the Arnie analogy, right? Like, or a quote that he said before. He's like, I'm not a self-made man. Everyone tries to quote him as being a self-made man. He's like, are you kidding me? The amount of coaches I've had, the amount of help I've had, the amount of people that have backed me through everything. You know what I mean? Like, you don't need to try and do everything yourself. And realistically, if you try and do everything yourself, you're going to make heaps of mistakes. And like, I look at my first 7 or 8 years in my journey, and it was good because I learned heaps. I learned heaps from, you know, hitting everything on the way up through the pinball machine and learning a lot of different things. But I look at what a lot of our clients achieve in a 2 to 3 year window, and it's the same as me sacrificing and going hard for 7 or 8 years. They do it in 2 to 3 years with us literally leading them the whole way through it, the right team, everything through it from that perspective. And I think that's one of the biggest things. Like, I take a lot of, I think I'm really humbled when I look at that and I think about it. And I look at how these guys are building their portfolios and setting them up and getting the right deals in the right locations. And we know what these areas are producing, or what's in the tank coming to these, and what those cash flow deals are going to produce when they're completed and all the rest of it. And setting these portfolios up correctly, you're setting them up to, in 10 years, they're probably going to have surpassed, you know, my portfolio. In literally in 2-3 years, most of these guys are surpassing my 7 to 8 year mark. And it's just crazy, you know, to be able to watch them. And I think, you know what, a crazy thing to think about with that, it was 9 years in, pretty much to the day that I got the phone call that I won Investor of the Year. You know what I mean? And like, so it was that far in that I won Investor of the Year. And a lot of these guys, I'm scaling portfolios to that sort of level, not in 2 to 3, probably talking 3 to 4 years if they're willing to go hard in that sort of time frame. Yeah. You know, and so I think that's really cool to like be able to handhold people's portfolios and help them through from that perspective and change it. And for those who obviously aren't working with us, which I know there's some out there as well, I think like you have to have a mentor from in this space working with it. And even if it's not a physical mentor, even if initially maybe it's school or property, you know, and everything that's broken down in there if you're trying to do it yourself. But I think this is one of those things where you learn as much as you can, but then the team piece is just so important to keep you going to the next level. And having someone who's been there before and then handhold you through this process as well, that's the absolute game changer with the whole thing. So, and man, where I see some, like, again, we go back to Yao Chen, worked with someone who supposedly was a mentor as well, but you find the right mentor, and in a 12-month turnaround can go from 30 grand a year negative to 300,000-400,000 growth positive and a net neutral portfolio. So I think these are the things, man, like I look at, and always goes back to the team and the strategy and having everything correctly in place to bulletproof your chances of success. You know what I mean? Like make them as ironclad as possible. And obviously, like, property is a game where things go wrong in the journey. You know, it's all part of it. But how do you get yourself as close as possible to success and guarantee it from that perspective? It's working with people that have done it before.
Which is a really good segue, Sammy boy.
He loves his segues. You ride a little segue around.
I
You would wear a helmet. We could wear a helmet. He gets the little,
I have a little
zip tags hanging out.
It's a tuk-tuk.
I actually reckon he goes on those Segway beach tours and he drives along the beach.
100%.
You know the ones that just got
comments he's made
just the disc. You know the ones that you just lean forward.
Yeah, I can imagine you on that.
Hits a bump, flips.
The space plants. Is that what you look like that?
Are you guys done?
No, there we
You
go.
done?
No. I still want to go.
Because you did mention about your fear, or you mentioned not. What did you mention before? You said your things will go wrong, mistakes.
Yes.
Which is a great segue to people's natural risk, right?
Yes.
How much do you guys think that? Because people in this podcast, they're conditioned to understand what is possible, but how many people out there just never think it is actually possible to own more than two because they just don't have anyone. They just think why would you ever own more?
I
than
think
two?
the most common thing that I get when I sit down with strategy sessions with clients, it's clients being, yeah, I get 50% of people that are like, this is what I want to get. And then I get the other 50% of people going, this is what I would really like, but I just don't know if it's achievable. And these guys are, a lot of the time, I work with obviously the clients that are a little bit further through their portfolios, especially if they're coming in. And they're literally the words that are said to me. I just don't know if it's possible. And I think this is the thing. It's preparing yourself for it. And obviously, if you're earlier in the journey from this perspective, and literally one of my key notes there was not having the right mindset around this, right? And being able to push past and keep going. That's why the very first question I asked you was, why did you not buy another property for 10 years, right? And you were trying to go it alone, you were trying to do it, and you found it difficult. Obviously, you're overseas, which makes it extremely hard, and you're busy running your own business and all the rest of it. But it's realistically, man, if you really wanted to do it, you would have done it.
You know, just going back, so I wasn't running my own business then. I was working on cruise ships.
Okay.
So I was away for 4 months.
Okay,
and then
so
I was
there's no
home
excuses.
I was home for 2 months. You're right. But during the 2 months that I was actually in Australia, I would read and go to seminars and all that. But I never took actions.
Yeah.
That was for me.
I remember you told me you did seminars and you did courses,
Did all the
everything
courses.
for 10 years, right? For like a decade.
Didn't take action.
A millennia almost.
A lot of courses.
A lot of courses.
A lot of courses.
I think one of the things I hear the most is actually my number one point that I put down was family and friends, not holding you back, but trying to keep you down to a degree. You know, you've got two now. You've done so well. Why don't you just stop?
So your family's influence of your progression is massive, and putting the blinkers on, because this goes back to the money story that we always talk about.
Yeah.
We're all brought up in a certain way to be conditioned about how we treat money.
Well, even for example, let's say your family's had no investment properties ever, and you've got two. They go to you, oh my God, you've done so well. Why do you need to keep going? Like you've done what you need to do.
What do you think I copped when no one in my family had investment properties and I hit 20
Yeah, that's not.
at like 26, 27, whatever it was.
And I think that would probably lead into the other point I had was fear of stress, you know, restricting their quality of life. Well, I've got two now. And the reason I use two is a lot of people, when you talk to them, they go, I've got two now, you know, I really don't want it to impact my quality of life. I don't want it to impact my kids. I don't want it to change anything that I want to do and cause unnecessary stress. I think that the transition between 2 and 3, that's a big mental barrier for a lot of people. Is it going to change my life or quality of life or my kids' quality of life if I go from that 2 to 3? And that's why the statistics are that so many people struggle to get past 2, because that's probably in a mental barrier, if anything, as well, or friends and family trying to pull them back down, or basically put their own expectations on them. Well, my expectations was never do any. You've done 2. That's more than enough. Just stop there.
Yeah.
I think realistically, it all just comes back to your own mindset. You know what I mean? You got to challenge yourself. You got to keep pushing yourself. Realistically, 2 properties is never going to retire you. So 2 properties, okay, great. Like even if you did a cash flow deal and a bread and butter, and the bread and butter doubled, and you pay the cash flow deal, okay, cool. You're maybe 30, 40 grand a year. It's not going to retire you. You know, like realistically, a great portfolio is going to take some big numbers to achieve. And everyone's got different goals, and that may be 5 or 6 properties, or it could be 20 if you got big goals. And I think it's one of these things is strap in mentally and try and consume as much as you can, surround yourself with the right people, and build it from that perspective, and don't listen to the people. And when I say don't listen, just don't engage in those conversations. I stopped telling my family how many properties I used to buy, because I started buying 2, 3 a year. I got to a point I was buying 4, 6 a year, and like there was a bit of resentment on that side, and just like worry as well, you know. And man, it just come one of these things. I just stopped telling people. I just stopped telling them what I was buying, and then one year I did 10, and I was like, fuck, I'm definitely not telling them that, you know. And that was in COVID. It was literally in COVID. I think it was 11 properties. I think it was that I bought in 2020 in Brizzy, and it was one of these things, man, where it's just like, sometimes you have to get. And I know we've talked about this so many times before on the poddy, but sometimes you have to not engage in that stuff and keep yourself away from those conversations, because if you're a bit fearful of this, you will eat into that stuff and allow it to sway your decision making and not do it. But realistically, can you change your family's financial future, or your individual financial future, with 2 properties? 1, 2 properties, realistically, probably not. You might change something in a small way, but you're not going to create that significant life-changing change, right? And so this is one of the things, you got to strap in for it. You know, you got to be willing to grit and grind and persevere through this stuff, and challenge things. You know, it is a challenge to make that shift that so many people can't, to get past 96% of investors in Australia and then get to 3. And then, okay, how do I get to 4, 5, 6 and take it from there and build it? And yeah, man, these are one of those things. And what I'll say and what I'll urge here as well is it gets easier. The first 2 are the hardest. The first one's the hardest. The second one's the next hardest. And then it starts to get easy, especially if you understand what you're doing. We're working with people who do as well and can handhold you through it so you don't make the mistakes. It gets easier. The longer you do it, it gets easier. Your capital base builds, your rents grow, all the rest of it. It gets easier as you keep building the portfolio. It's not the time to put the halters on. It's the time to put the burners on and actually push this thing into gear, because this is a time where you're going to get results. 2 properties, okay, great, well done. When you start getting to that different level, that's where it compounds, right? Think of the idea of, you had 2 properties, let's say they're 500 grand each. And so you're $1 million worth of property and you see 10% worth of growth. Right? You make 100 grand that year. Maybe you have a great year and you see 20% of growth. You make 200 grand. Imagine if you pushed hard, or just pushed a little bit for the next 2 years, and you bought a property every 6 months for the next 2 years, right? Now you're at 3 million worth of property. You got 6 properties worth $500,000, just to use that same analogy. You go through the same growth run. You see the same 10% worth of growth. Now you're making 300 grand. Or if you saw the 20, now you make 600,000 in a year in growth. That was when I had my light bulb moment, when those things started to happen. And all of a sudden, like that example before, I was a very low income earner. It was so hard for my portfolio. I struggled so much to keep it positive until I sold Wollongong. And so I would pull out a little bit of cash every year to cover the shortfall I knew that was going to be there. But I was making like 60, 70, 80 grand a year, whatever at the time. And my portfolio was generating like $400,000-$500,000 a year in growth. It's like, this thing's a no-brainer. And this is how, and then it gets easier.
Yeah.
Especially if you understand the correct properties to put in, the correct way to structure. You've got the right team around you, which I finally found when I was 27, I think it was. Found the broker and the accountant that I work with now. That was the game changer.
When you're talking about those numbers, and further to your point, Lukey, when people are talking about they don't want the hassle, and when you ask them, how long does it actually take you to save $100,000?
Bro, how hard do people work in Australia for 100 grand a year?
I know, it's incredible.
100 grand a year. But
Exactly.
then they expect out of their portfolio in 5 years, an unrealistic goal if they're not willing to go hard. But they don't understand like the amount of work that will go into it to generate it as a passive income. That takes a lot longer.
different.
But to make 100,000 in a year, you buy that 500 grand property in the right location. Let's say you buy with a 5% discount, and then it does 15% worth of growth. You just made 100,000.
So it's worth it. That's what we want people to understand.
Of course.
The reason why it is worth it. It is worth it.
And if you want to preserve that quality of life, sorry to cut you,
No,
boys,
you're right.
I'm on a
go for it.
offline here. But if you want to preserve that quality of life, that's the point here. Where if your portfolio is running currently neutral, but you haven't bought anything in a few years, and you've had a lot of rental growth, whatever, and this would drop you down to 10 grand a year negative. It's like, okay, but you got $500,000 worth of equity. Let's pull out we'll buffer a spare 50 grand there, so it will not impact your lifestyle at all, because you've got 5 years worth of net negative holding costs there of your 10 grand. Let's say if we put these few extra deals in here, you won't even feel it because the portfolio is going to be holding it. But what's the opportunity cost there? If you did those 2 deals, that same example before, literally just scale it up to the next level, you make $200,000-$300,000 in growth for the expense of $10,000 a year. It's a no-brainer. But how much is that going to change your position? And then the mental capacity to be able to keep building and going beyond that. You'll want to do it, but you're stuck at that point right now that you need to get over. It's like that speed hump when you're in the Ferrari. You need to put the lift on. This is a lift to get over the speed hump, and then you can take off.
Funny story about that. When Sammy was driving me around, he goes, "We're going to put the lift on to get over this speed bump." And he did. He really did.
When I just got to get up a gutter with Lukey, I got to put the speed bump.
I have
the
not
lift
been
on.
in the Ferrari, Lukey, so I don't know what that's like. Yeah, never offered me a drive.
There's a reason for that.
Who puts a dog in the Ferrari? Man? You know, so I'm not going to put Bear in.
You could have
What
put the
you
dog
in?
seat, the mat.
The mat. Yeah. That's why I throw you in the Defender in the back.
But you know, we're talking about lifestyle, and it was
Yes.
a very good rant from you, Sammy boy. There's
Yeah,
so
it
many.
went on a bit
There's
there.
so many truth bombs there. But when we talk about lifestyle, I often ask people, okay, so what do you really want? Like, delayed gratification is all about giving you a better future. So if you're focusing on your short-term lifestyle, understand that may be to the detriment of the future self of you and your family. So not saying don't have a great lifestyle, but understand that if you're not doing the work for the future,
You've got to earn the right to retain the right lifestyle.
Yeah.
Okay. And so like that's where I'm saying if you're starting a position, you've got a bit of equity, you can pull it out and then safeguard against that no change in lifestyle. Sweet. Bang.
Yeah.
We've covered it. But if you don't, you haven't earned the right for it yet. You don't want to impact the lifestyle. Well, mate, you haven't done that. You haven't taken the steps yet to preserve that. So you want the result, but you want to retain the lifestyle. Okay, well, maybe we've got a bit of sacrifice here for 1-2 years, build out the equity base, and then release an equity buffer as a if that's the case, or if you've got enough that we can build in there from a buffer perspective that it won't impact the lifestyle, because you got to earn the right. Man, I'm sick of people with the entitlement of I want this, I want that, or I don't want this to impact this or that. Have you earned it yet? If you haven't earned it yet, don't fucking ask for it, because you haven't deserved it yet. You have to earn this stuff, because what you will find is the more you do this and the more you do this and the bigger that it gets, you will understand the game and why you're doing it, because you're going to be banking 400-500 grand a year in growth. Those properties that are sitting 10 grand a year negative, you go through a nice little growth cycle in terms of rents and interest rates come back a bit. All of a sudden, your 10 grand a year negative in 2-3 years is now sitting at 20-30 grand a year positive, because you've had that transition, but you did the sacrifice for 12-24 months to get into that position to now have that, and then you can put the portfolio on steroids.
I love it.
It's pretty rare. Like, we do have people occasionally come through and they go, I want the growth and I want the numbers, I want the result, but I don't want to spend any. No. I don't want it to cost me anything. And I said, well, if I told you now that you had to spend 10 to make 50, how many times would you do it? Oh, heaps of times. It's the exact same concept of what we're deploying. You know, we're okay to spend a little bit negative on a property and hold that, because we're holding 5 or 10 to make 50 or 100. You know, how many times can you do that? And what you're talking about is your 400-500 a year. Is as you scale, you're getting that across multiple assets. So
that leveraged return is unbeatable.
I think what you said there is you got to earn it. You can't get the 50 or 100 without spending the 10. You know, so you've got to have some skin in the game and have a bit of risk there, because you know.
Is that a mind blank, guys? Is that a mind blank? I think the Matrix just unplugged him. The big boy just went, oh.
We're cutting that.
Fuck off. No chance.
Full mind blank. That's Sammy's fault. We'll talk about it later. But
you know what, but man, like, I agree with you on the point. Even though you had the mind blank, I'm embarrassed to have you in the team. I'm only shaking. I love you. But I think it's one of these things, mate. It's who am I impersonating?
No.
We are definitely not cutting that.
Add it to the blooper reel. Add it to the highlight.
That was good.
You got to earn the right.
I was waiting for you to say something, and I was like, oh, fuck you.
You've got to earn the right. In all seriousness, you got to earn the right.
Yes. What you're saying is 100% right, Sammy.
And we're in the marketplace right now.
You're right.
Where you can't just buy a bread and butter and expect all the growth and not have the cash flow. And this is where so many people during COVID, they got used to that, or they came into the market and they'd never done it before, and they thought that was a status quo. They thought that was normal. And I told everyone, I told you, because you challenged me on it. You go, no, I just want to keep doing the cash flows. I go, mate, well, you're going to need some debt reduction here at some time. Why don't you need debt reduction, bro? Interest rates are 2%, 3%, whatever. Like, this is glory days. I'm like, mate, it is never going to stay like that. And this is the part you have to understand the entire strategy, everything we're doing. You can't expect this just to be the golden goose across all things, because realistically it's not. It's not. You have to understand the different levels of this thing, and then building and earning the right for the different size portfolio to build it and how you're going to build it. So yeah, man, this is all an evolution of the portfolio that you need to go through the stages. And the really important thing to note is during that accumulation phase, you have to get ready for undoubtedly a little bit of sacrifice. Unless you've already earned the right, the accumulation phase, you have to understand that is the period where it's going to be a little bit tough. It's going to be a little bit tricky. But once you get past that, again, we get past that speed bump, that's where the real gold is on the other side. And this is where so many people get stuck at that 1 or 2 properties, that 96%, whatever the hell the numbers are, the ridiculous numbers of how many people get stuck at that, is because they don't get past this point. So I want to challenge any of you that and I hope you all took, the value away from this as to what is possible if you push past it. And if you think those numbers I'm throwing out are airy fairy or whatever, I literally was getting them nearly 10 years ago in my own portfolio during that period when I was a super low income earner, because I'd sacrificed and I scaled that first part of the portfolio, and then the growth did its thing. And it literally is possible. Work the numbers on having a $2-3 million portfolio and being in the right market that produces 10, 20%. Some of our markets will do 30% plus this year. Same as last year, same as the year before. Some of our markets will produce that. Work out the ratios on that. I'll tell you right now, $3 million portfolio, 30% growth, $600,000. That is massive. 30%. No, it's not. It's $900,000. 20%, 600 grand. Even just a 20%. But the 30% is $900,000, Jimmy. Nearly $1 million.
How long would it take you to save that kind of money?
The average income in Australia makes 88 grand a year or 89 grand. It's 12 years of work to make the same as what you could in
Not
growth.
savings, work.
Yeah.
Just work.
Yeah.
I'm glad I picked up on the old growth percentage error there. I know Lukey was about to pull me
was
apart.
about to jump. He was-
I fucking got it.
Yeah,
No,
yeah.
Oh,
He
he
was
got
waiting.
in just in time. Yeah, he's already ripped me once. I'm like,
Well,
here
I'll
we
probably
go.
delete
He's
out
like-
me saying the. No, I'm joking.
He'll leave my stuff up in and then he'll cut his out.
I was quick enough that I rectified, so it's all good. You weren't.
I think-
you got pulled from the matrix.
This has been a great episode.
Unblocked.
I'm gonna ask you, Sammy boy, because why do people get stuck with 1 or 2? Can we do an episode of why people get stuck at like 5 or 10? There might be a series here about why people get stopped at a certain point. What do you think?
I feel like that series will be so detailed that is going to be for the podcast vault within School of Property.
Okay.
If
The
we're
reason-
going to apply real life sort
Well,
of stuff to
speaking
it.
of education, because for me, getting
Yeah.
beyond 1 or 2 was literally outsourcing it to someone like you. That is the only way
Yeah.
that I was going to get beyond 1 or 2. But I pose to our listeners, if they've got more, there's going to come a point where you need to educate yourself more, because there's only so much you can take advice from someone before you start going, oh, I'm not too sure why I'm doing that.
You know what though, man? In School of Property, there's literally the strategy section, right? And within the strategy section, I have a segment in there of unstuck yourself. And it's
Go unstuck yourself.
mate. Literally, man. And the whole idea of School of Property is to give you an entire understanding of what you've done in your portfolio, what you're going to do, and preempt the failures or not the failures, the mistakes that you might fall victim to, right? And so, man, the whole thing is wherever you are in your portfolio, especially if you're stuck, this is the blueprint to effectively get out of it. And man, that's why with so many of the guys, like when we're talking about the APS memberships, right? Like people know about it. And now obviously we've come out and done a bit about it, but the APS memberships, effectively it's the partnering between School of Property and Australian Property Scout, because we want you to be educated so you also understand it. So we're building the strategy with the educated investors who already know why we're doing these things. And then we're just helping with the final pieces of, okay, what do we need next? And here's the execution piece. But you're building that knowledge base so you literally have that for life in terms of how to build a portfolio.
Love that. Yeah, spot on.
Boys, anything else to wrap up with this? Lukey, any other points?
No, I'm unplugged for the
You're
rest of the
back?
episode.
You're back? Okay, sweet. I wasn't sure if he was back in. I wasn't sure. Jimmy?
Sammy, I think we've nailed it. Take a listen to your first 2. You know, back into your portfolio,
Yeah.
when you did your first couple of deals or 2 to 6,
Yep.
I highly encourage people to go back to those and just to listen to what you did. I know it was very different then, but also just to get some inspiration as to how difficult it was for you to bounce between so many different strategies.
Let me ask you something. Why was it very different back then?
Well, I think it's different for you because you had to change your approach and do a whole bunch of different things. That's what I'm saying to clients. When they realize what you had to do compared to what they have the option of doing today,
Yeah.
they're going to fast track their results. They don't have to drive 5 hours to do a renovation because they can buy in the right market that's going to do 80% of the heavy lifting without them even lifting a finger. So that's what I just want them to get an appreciation
100%.
as to how difficult it was.
What everyone can understand right now is the way that we build portfolios and the properties that we source for clients now are what I built when I realized how it worked.
Correct.
So like the first 5, 6, 7 properties in my portfolio, I was still hitting things on the way through, trying to figure it out.
Yeah.
What everyone gets now is they get the finished product of 15 years in the game, and I don't know, we bought something like 2,000 properties or something, you know, as a team, including myself, and obviously what we've sourced for people. And it is the understanding and the amount of portfolios that we've built to double digits now and beyond as well. The understanding around how to build that's everything, man. And that is what the properties we source now. That's why I bang on about it, man. That's why I don't deviate from strategy, because they work with what we need to do and what we need to build out in a portfolio. And that's what you guys get the benefit of now. The back end of all that time, effort, energy, research, sacrifice, figuring it out, smacking the head against the wall. Boom.
Love it. Love it.
Beautiful. Boys, anything else?
All good.
I've enjoyed this, boys. I got fired up. I'm ready for a steak.
You ready for a pie, Leaky?
Absolutely. I was about to say before, like when somebody was talking about like barbecue talking and ignoring people, I was like, if you're at a barbecue and people are talking smack about property and what you should do and
Throw a
not
sausage
should
at 'em.
do, just go and do what Sammy do. Go check on the steaks and see if they're ready, because he's keen for a feed.
He'll already be eating them, Leaky. He'll already be eating them.
I won't be away from there anyway. I'll be checking them as it is. Listeners, I hope you enjoyed the episode. Thank you, as always, for tuning in. If you took some great value, or you know anyone that might be stuck at this point or going through the early stages of their portfolio and they might really need to hear this this thing, I encourage you to send this episode on to really help them level up, understand what they're doing, and take their investing to the next level. If you want to check us out any further, make sure you head over to www.australianpropertyscout.com.au. If you want more information on School of Property, which we mentioned a couple of times, head over to www.schoolofproperty.com.au. And obviously, we're also at the socials, guys, at Australian Property Scout. And until next week, guys, it's another Scouting Australia podcast.